Hi, everyone. Welcome to a brand new episode of In the Money with Amber Kanwar. The markets are on tenterhooks as we await the details of so-called Liberation Day. This is when the U.S. is going to announce their tariffs on all their trading partners. We spoke with Dan Rohinton of IA Global Asset Management, who's been buying in this market. He says as a result of all this anxiety, you actually don't have to make it harder than it is. And a lot of good ideas are hiding in plain sight. Let's find out what they are. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. If you're a do-it-yourself investor, BMO InvestorLine Self-Directed is the perfect platform for you. With powerful tools and commission-free trading on over 100 ETFs, you'll have everything you need to take control of your investments and build a portfolio that's right for you. Learn more at bmo.com/investorline. Dan Rohinton, thanks so much for joining me.
Thanks for having me.
So we are here together on the eve of so-called Liberation Day in America, which is when the U.S. is going to unveil what tariffs look like on all of their trading partners. And the markets, Dan, are freaking out ahead of this.
Boston Tea Party 2.0, or so we might know, we might not. But at the end of the day, when you take a step back, they're trying to realign the global economic order and the global maritime order in a way that is more beneficial to the United States than it has proven out to be in the last few decades. So we'll see how it goes, Amber. But I think in the grand scheme of things, we need to take a step back and understand that these are big changes. They take time, and there's no quick fix for anything, irrespective of the administration in charge. And there are secondary effects that do happen as well.
So how do you think about that as a money manager? Are you prepared to weather the near-term volatility? And then you're taking this long-term approach. So, are you all in on what that structural shift means for America?
I think it's a little hard to really. So let me take a step back. When we talk about tariff regimes, there's historic evidence to say they don't work, and the second order effects are even more negative. So the last time, and it's become a lot more in the public discourse today, the Smoot-Hawley tariffs, those guys ran out of town and were never heard from again. So they were in political exile as those tariffs failed.
And this was in the 1920s.
That's correct.
So, maybe this is a little bit of history repeating itself 100 years later.
And the reason that the net export position of the United States improved was because imports fell, because consumers started, getting more conservative, and it was net decremental for everybody. But let's take a step back. That was a long time ago, quite literally 100 years ago. The global economy today is very different. And if you say that the United States is trying to pull in jobs that were getting outsourced to other parts of the world, so two types of tariffs. Strategic tariffs against semiconductors. Think of the AI chips. Expect biblical levels of sanctions there and tariffs there, because both countries, China and America, have made the call that AI is the next super race and the next space race. So that is going to be tariffs on a structural basis and sequestering of resources on a structural basis. The second part is, we don't like that Canada doesn't spend enough on defense. So, and we don't, 1.4% relative to the United States at 4%. So let's rebalance that a little bit. Let's force Canada to push it along. And if we can get some jobs back in Michigan or the southern United States that might be sitting actually right around where I live on the east end of the GTA, then that's a win anyway. So there are those types of, call it transient tariffs, and you don't know what ultimately the administration's goal is, but the reality of the situation is you can't truly price that out into any individual security outside of avoiding the true hotspots. So auto companies, auto parts suppliers, sure, we can avoid those because they're directly in the firing line. The same thing on the semiconductor side, making sure you do the analysis, that you don't own the companies that are basically laundering the H100s and the A100s into China, you can do things like that. But these are all very marginal things in the grand scheme of things.
And those chips that you referred to, those are semiconductors that are somehow finding their way into China, even though they're not supposed to.
Exactly. Through the back channel in Singapore, realistically.
So what do? Are you just sitting on a ton of cash and waiting for clarity?
We're actually buying more of the big tech companies. So I think it's times like these, you have to take a step back and realize the market is derating some of the best companies in the world. And it's actually an opportunity to lean in a methodical, constructive way. So that doesn't mean you shift from one end of the barbell, hyper defensives, consumer staples, utilities, gold, to high growth momentum. But you do have to really ask yourselves, is it worth buying Mondelez at 30 times earnings or Google at 15 times earnings? In my mind, the answer is obvious.
And we're going to talk about that in Pro Picks, but that also speaks to that old reflex that you just always get rewarded in buying the dip. And the changes that the U.S. wants to enact just seem so large. To use that, doomed phrase, this time is different. Yep. How do you think about the risk of this time you won't be rewarded for buying the dip?
Potentially not, but that's why you have to look at it on a company by company basis. So if you say that, like, I'll give you an example. Retail is definitely in the conversation here because China is a major goods exporter to the United States. And then those excess savings that China generates by selling the knickknacks and toys to the United States gets recycled back into treasuries, which help. It's known as the exorbitant privilege that the reserve currency status of the US dollar brings, which means, and to put that in plain language, frankly, it's all of the excess savings in the world find their way back to US treasuries because the US dollar is the currency of the entire world. That's what a reserve currency is. So I'll tell you, where am I going with all that? What I'm trying to say is there are those types of regimes that you can see are shifting, but you have to ask yourself in the stock market, where is that most acutely felt? That is felt in retail, but generally speaking, brick and mortar retail and some of the smaller companies that are directly and disproportionately impacted by that, they're not major parts of the market. So it really comes down to, does this do anything to consumer confidence? It is sapping it right now, but if they start backing off of the tariffs in any capacity, say in 6 months' time, that might lead to a rebound just in time for the midterms.
So I'm so glad you brought that up because it's kind of binary. Either the tariffs will be worse than expected or they'll be better than expected. And then all of those penalized sectors in manufacturing, I mean, it's across the board. Look at Air Canada, it's trading at the lowest level since May 2020. Are you tempted to position in any of those binary outcomes where they've been penalized so much by the potential of tariffs, that if tariffs are even a whiff better than feared, you could get a pop?
So it really depends, Amber. And just to be a bit more nuanced on this conversation, some companies, if you add leverage to the conversation, is a true liquidity and credit event for them. You never want to position yourselves in those situations. But I would frame your question a little bit differently and say, are there asymmetric outcomes in the market today because those companies are disproportionately feeling the effects of tariffs? I believe so, because the blunting mechanism over time is price and pass through, which ultimately leads to inflation. And that is where you can have the conversation, but that's at the macro level. So you have to have pricing power in this environment. That is critical to defend profitability. And you have to avoid leverage because that can magnify any of the shocks, of which this is one of those shocks.
So is there an example that you have of a stock that presents kind of an asymmetric outcome, doesn't have the leverage problem that you think could be interesting?
I think the Canadian rails are interesting. So if you think about in the context of the Canadian market, and we run Canadian portfolios, US and global portfolios, so I'll kind of just jump around in different parts of the world. The Canadian rails, their market position has been reinforced for the past 100 years. They have the ability to drive positive operating leverage through volumes, and they have, generally speaking, the ability to manage their cash flows. So at the end of the day, if you see rail tonnage fall, that does hurt them, but it's not a credit event for them.
And we're going to talk about those rails because it's one of the questions in the mailbag. But you bring up an interesting point about Canada versus the US. So the US has got its own thing going on. And then we, as Canadians have to respond. And one of the ways we're going to do that is through the election. It's a very consequential election for all Canadians, also for investors who typically, I would say, can ignore federal elections. But now it looks like the Liberals are going to get a fourth term, this time under Mark Carney. At least that's what the betting markets are suggesting and the polling. And we're less than a month away. And there are all kinds of goodies that are being dropped around that affect investors. Pierre Poilievre just announced measures that would basically defer your capital gains tax if you reinvest in Canada. Since the Liberals like to borrow from the Conservative platform, I wonder, like, as an investor, does that make you sit up and take notice?
Normally, my approach to elections and politics, I'm a big political nerd, so I can get into all these details. But when I put my portfolio manager day job hat on, my approach to this stuff is the old bums got kicked out, the new bums start moving in, and so on and so forth. And that's true. And I say that in a bit of a joking, half, condescending way, but that's true for presidents. That's true for the markets, just like certainty. So they want policy certainty in Canada. And everything you just said, in my approach to this is just, let's get universal basic income and let's avoid all these little indirect ways of getting to that same outcome, because the handout approach it works for polls. And it does drive deficits higher, and it does put the onus on the private sector because it does tend to crowd it out. So there are long-term downstream negatives that come with basically offering handouts in the midst of elections. But this has been true in Spain forever. This is true in Germany. It's true in many parts of the world that this is how politicians win votes. I'm not too worried about necessarily who's in charge. I think the structural position for Canada, I think, is vulnerable. And that's not because of the Trump tariffs per se or the negotiations with whoever our prime minister may be. It's that our consumer leverage is extremely high. So we are vulnerable and have been vulnerable for a very long time to any adverse shocks, Amber. That could be a low oil price. That could be low broader materials prices, or it could be a job shock, which is what tariffs would be over the medium term for the Canadian economy.
And yet the Canadian stock market, which is not always a representative of what's going on in the Canadian economy, is outperforming. And that's part of a broader trend where just global stocks are doing better than the US. What do you think about the waning dominance or the fact that the reaction to US tariffs, which were supposed to make America great again, is to sell American stocks and buy everything else?
Never count out America. And I say that as a proud Canadian. But when we think about and let's decompose your question a little bit, and I'll go geography by geography. Allow me to ramble.
Yes, go.
So
that's what the podcast is for.
Exactly. No time, right? So the first point is when we think about the Canadian Stock Exchange, it's only 40% domestic. And those domestic profits are centered specifically around the banking sector in a disproportionate way. So hold out hope that the credit cycle doesn't adversely turn in Canada, because this conversation for the TSX might take on a slightly different flavor. When it comes to Europe, Europe is moving in an idiosyncratic manner because they're finally taking what the US playbook was for the last 10 years and then rolling it into themselves. So the loosening of the fiscal brakes in Germany, which will effectively be, and the Bundesbank was historically the most hawkish fiscal conservative of I commingle monetary and fiscal policy, but the Bundesbank was the most hawkish when it came to this. And so the German economy letting loose with the fiscal taps will help stimulate, but that doesn't change the fact that when you look across the European market, you have financials as the anchor of the portfolios, you have real estate, you have basically in most economies, they're regional areas of focus. So the DAX is the autos as an example. Italy has some consumer brands, but financials are the through line, and they've been the strongest performers in that market. That's not to say that it's not going to keep going for the next 6 months or the next year. And I am constructive on Europe, don't get me wrong. But that's not a 10-year thesis. The 10-year thesis is research and innovation, cash flow generation, and frankly, the United States is still the best of the bunch. And the last piece on this conversation is, I know you're going to bring up China as part of this because China's also seen a tremendous rally. No doubt about it, but the Chinese economy is largely speaking, the public side of what we see is the Alibabas, the Tencents of the world, but they are a very small piece in the grand scheme of things for China. China's debt problems are an ongoing problem for them to have to manage. And we're just seeing in the hands of Baidu, Alibaba, Tencent, maybe BYD, a strong resurgence, but the structural issues in China have not been solved either.
So you're not chasing the Chinese market here?
I'm chasing China 0%. I'm constructive on Europe tactically, and we have added to Europe in the portfolio. But where I'm the most excited as we look ahead is actually America once again.
All right. That's super interesting. And we're going to dig into some of those ideas. And just to underscore your point on Germany, the fact that they are saying we should spend, it's almost like your Depression era grandparent telling you to go out and buy a Ferrari.
Yep.
Like that's how much of a sea change that is. So it is a big awakening out of Europe, but it's so interesting to hear your perspective that that's not a 10-year thesis, even though it's working this year.
For sure. And we've been participating in that too. And I'll tell you, the biggest success story in Europe is actually the German military industrial complex. So I believe the rearmament of Europe is a decade-long phenomenon. But I don't know if I can say that for the commercial credit cycle there. And it's really those types of elements that play a bigger role. And the biggest employer in Germany is also the auto sector, which is losing tons and tons of market share to their biggest market, which was historically China, which is now becoming its biggest competitor. So the headwinds are there too in Germany, let alone the broader European continent.
So that speaks to don't just chase that market. You got to do your homework there. This is enough macro for me. Let's talk about individual stocks and we'll dip into the mailbag. Okay, our first question in the mailbag, we were talking about the rails, is CN Rail. That's fallen approximately 20%, lagging the index heavily under CEO Tracy Robinson. What is it going to take to get CN back on track? I'll excuse the pun there, that one coming from Samuel in Toronto. Full disclosure, I own CN. I bought it because I was like, it's trading pretty low. With a 10-year time horizon, does it re-rate higher?
Yes. So rails, you're not building any more track. The class 1 rails are as strong as they go. There's a potential in the future of an east-west merger, but that's frankly a long ways away, and I don't know if ever. So when you look at what they have is they have a pretty strong network. The reason the stock's off 20% from the highs is not only because of tariffs, it's because there was an expectations of a freight recovery that did not happen. Just look at the TL and the truckload and the less than truckload truckers. Those guys have really sold off as well. So when you own a rail and when you own truckers, you don't own the inflation nominal economy. You own the real goods economy because they move physical units. So that has been some of the headwinds, but over the medium term, you want to pick up these companies as they're trading close to the troughs of their valuation, and they have all the levers to buy back stock, recycle capital accretively, and do the odd bolt-on here and there. CN fully fits that bill. So we'd be buyers here.
Let's contrast CN Rail with some of the other options, because all those other rails in theory could fit that thesis. And the viewer specifically calling out the leadership at CN Rail. Is this a leadership problem? Is this a sector problem? Does CN need to go activist on itself the way CP Rail famously went activist?
So what's interesting? The Hunter Harrison era basically normalized performance across the board for most of the rails. So the era of precision scheduled railroading, which was pioneered by Hunter Harrison, really permeated the whole industry. So you don't necessarily need an activist. All the rails go through the ebbs and flows of optimizing for their OR, their operating ratio as it's known, and onwards to then chasing volume. So I don't think CN needs a real sea change. It's just we're in the oscillating cycle between focusing on profitability and then trying to blend in growth and then going back to focusing on profitability. So leadership in the rails today is nowhere near as important as it used to be.
That's interesting. So let's take a look at the stock trading at $140 per share. Last year it was trading around $180. Where do you see kind of fair value?
I think 160, 170 on the way there would make perfect sense. But you have to understand, when we're thinking about portfolios, we put it in different buckets. This is absolutely the cyclical industrial bucket with a low beta to it. So you have to think of it in that context to the caller. And that's how I would put it, is as part of the cyclical recovery, this would be one of those attractive positions to average into, barbelled with defensives on the other side of the portfolio. Okay,
let's go to another part of the TSX, which is the financials. Which Canadian insurer do you prefer, Sun Life or Manulife? This one coming from Rita in Winnipeg. And Sun Life has been a laggard recently compared to Manulife.
Yeah, and there's a few reasons for that. So I'd say on that binary conversation for Rita, Manulife over Sun Life, and the reasons as to why. Manulife is the cleanest it's been in a very long time. So it's got scale, the Asia Pacific business. I have questions about the long-term pricing and the multiples they're paying for it, but that's not necessarily today's problem. That's 5 years and 10 years from now. And what Sun Life is going through is they're basically seeing outflows in their MFS, their big asset management divisions, which off the top of my head, I believe is about 40% of their core earnings. So quite significant. So it's an asset manager with a large life insurance component to it. And their US medical stop loss business, they were caught offside on cost there, and they're going to have to make some changes there too. So there's a bit more hair than usual as it comes to Sun Life, which I think will mean revert over time. But when you have Manulife trading at broadly the same valuation with the cleanest capital return profile that we've seen, frankly, in a decade plus from them, and a broadly de-risked portfolio, tie goes to Manulife.
Manulife's trading, 45 seems like the new lid on the stock. For a long time, it was like $27 was the lid on the stock, and it blew past that. What do you see as like a catalyst above $45 per share for Manulife?
Risk markets. So life insurers as a whole, just given the nature of the business, are basically, they provide puts and stop losses on the way down for their clients, hence the name life insurance. But on the way up, they have convexity to the upside. So there's a lot of hedging that goes to try to buffer those ups and downs. But for basis risk, for breakage ratios. So basically, hedging is not perfect. That's a very complicated way of saying hedging isn't always perfect. They do tend to be geared to the upside and geared to constructive markets.
So if markets go a little bit more risk on Manulife benefits, we often think about insurance companies doing well in a rising rate environment. Interest rates are coming down in Canada. How does that hurt them?
It doesn't directly hurt them as much because they can globalize their portfolio. So that's the other part to it. Is it's not just an equity market conversation. Higher equity markets tends to mean over time. And I know the 2010 era was a little bit different. So we can take a little time out from this statement for that decade. But higher markets is higher interest rates. And a life insurer has a very hard time reinvesting its 30-year liabilities in 30-year bonds. So you have to go a little bit shorter than that. So they're always a bit mismatched in their asset liabilities in some capacity. So higher interest rates, along with higher equity markets, tends to mean higher recycled earnings and more constructive investors, which means the stock tends to go up.
Okay, so
during those environments.
Let's talk about that in the context of the Canadian banks, rates coming down. Which is your favorite Canadian bank? This question coming from Steve in Hamilton.
Royal Bank. And the reason it's Royal is because the other ones are priced more for perfection in this current environment.
Royal isn't?
It is, but it's a relative conversation, right? So in Canada, I always think about I wear two hats. When it's global, it's addition by addition. In Canada, it's addition by subtraction.
What does that mean?
So which companies do we want to exclude from the portfolio in the 50 stocks that we do have in Canada? So when we think about the Canadian banks, it always has to be in the context of the other Canadian banks. So CIBC is more sensitive to Canadian credit, although they made a huge turnaround in recent years. And Royal has the most diverse fee mix. So although it's a bit more asset sensitive with its wealth management and capital markets revenues, it still has the cleanest portfolio when it comes to personal and commercial banking. And the biggest risk I see for the Canadian banks is the credit cycle.
And so I want to talk about that in the context of like broadening it out to some of Royal's peers. That Royal just came off of an investor day, and from everything I read from analysts, it was kind of just glowing reports. They're dominating in their fields. They're kind of number one in most of their categories. Contrast that with like a Scotiabank right now, which just got a downgrade from an analyst, in part because of their more direct exposure to tariffs, right? They operate in Mexico, they operate in Latin America, and now you've got Scotia trading at the lowest level since August 2024. That kind of dip is not tempting to you?
Scotia has the most upside of the Canadian banks, but beware bank turnarounds. So just ask Wells Fargo how long it took to turn around the business. Scotia, as recently as 6 months ago, was pivoting away from more of its other Caribbean exposures into Mexico. And look how quickly that changed too. So especially with emerging market economies like Central and South America, you have to be careful about just the money laundering piece. Let's not ignore that, especially with how much the United States is focusing on the fentanyl trafficking. So you got to be careful.
But that dented TD. You think that could other banks could be painted with that brush?
I mean, it's a guess, right? But what's more likely to be directly exposed to risks as it relates to money laundering? A bank that has its footprint in Mexico and the Caribbean, or New Jersey, where TD got taken to the woodshed. So I'm just saying, when you think about these things, the ROE is higher, the potential upside is higher because the capital release and the future earnings for Scotia, if they can turn it around, when they probably turn it around, I will qualify that statement because I do think it'll eventually work. But you have to take that upside in stride with the potential risk that if there is a far more significant crackdown on any kind of money flows in and out of Mexico, along with a tariff regime that hurts Mexican investment and the Mexican economy, Scotia is disproportionately exposed relative to the Canadian banks.
So it sounds like you put it in a watch list, and if things start to improve, this is the one you go to.
We'll always look at every Canadian bank and it'll always be on the watch list. But my focus today is the most diversified business that's out there in the Canadian banks and the most conservative underwriting on Canadian consumer credit. So the Canadian banks have unique headwinds, each their own. But as a whole, I'd say Royal still stands out far above, even though it's the most expensive, even though the upside isn't all that significant from here.
Okay, but you just hold it basically. Wouldn't add here.
I'm not excited about it.
Let's see. We're going to find out what he is excited about. Don't worry. But let's talk about REITs. Where do you see REITs in the next few years? Real estate investment trusts. Currently, most REITs are trading at lower prices. Will lower bond yields help them? This one coming from Anurag in Barrie.
So it depends which REITs. The answer is universally probably. But if you own a gaming and a lodging REIT, that's far more sensitive to consumer incomes. So REITs as a whole, the next best alternative to a real estate investor is the government bond. The same is true for utilities. So I would tell you that statement would broadly be true. Owning REITs as interest rates are falling is generally good, as long as their rent rolls are not exposed to whatever the reason interest rates are going down.
So a softening consumer, you might not want to get into like a rental REIT, for example, that has difficulty increasing its rent prices. So then where's the sweet spot? Is there a sweet spot in REITs right now?
So I actually like utilities as a better expression of this entire conversation because they're rate regulated. They have the organic growth if you're in the right jurisdiction, and you have that stability as opposed to some of the more economic downstream effects that REITs might face from time to time. So rather than picking and choosing exactly which sub-asset class of real estate to focus on, utilities can be a better, more defensive part of the portfolio, and consistently so, than REITs. So for me, Ty has always gone to the utilities over REITs.
Okay, well, we're going to take a quick break, and then we're going to talk about some global stocks. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit RaymondJames.CA today to discover how you can live a life well planned. Okay, our next question in the mailbag is about your favorite Canadian oil stock. This one coming from Nathan in Peterborough. So how do we think about oil in this broad conversation of tariffs? And do you like any Canadian energy producers?
So I think consistently for us, Canadian Natural Resources is that foundational energy producer. The reason for it is that they're low cash operating costs. At the end of the day, you can't really produce below $40 a barrel anywhere in the world and on a sustainable basis.
They make money as long as it's $40 a barrel and above.
Exactly. And they tend to consolidate the basin more and become more dominant in the patch every cycle that oil takes a downturn. So when we take a step back, is there offtake issues in the Canadian market? Should we build more pipelines? Of course. But in the absence of all of that, Canadian Natural Resources is that foundational play. And it doesn't bother me that it's not vertically integrated like some of the other peers, like Suncor, if you will. But when you think about energy as a whole, Amber, The midstream companies tend to take more of the profit pool over time anyway. So if you're thinking purely energy in terms of producers, I think Canadian Natural Resources is a solid blue chip and globally competitive, but midstream in Canada tends to be pretty attractive too.
All right, so that seems like a fan favorite. We have a lot of people who recommend CNQ. I guess it's one of those stocks you don't get fired for owning CNQ.
And you get the beta on the upside in energy, and you get the capital return irrespective of the oil price, which gives CNQ the tie over the higher cost producers or the more wildcatters of the patch.
Okay, let's go a little bit global. We're talking LVMH with this next question. John in Montreal says, I did very well on LVMH in 2023, but since it has come off a lot, would you recommend buying more here, holding, or selling? And for perspective, LVMH on my chart just broke a low, just broke through the 24 low and is now trading around the lowest level since 2022. What's going on in luxury?
Yeah, so it's a buy. It's a buy for multi-years, and it's a buy I would do right now. We do that. We're doing that, right? I say that because we're doing that right now in the portfolio for LVMH. And I'll tell you what's going on with how we got to this point. So there was a boom in luxury demand and luxury spending through COVID, and the echoes and the other side of that conversation is what we've been grappling with. First has been the lack of pull-through in demand from the reopening of China. Now, more recently, has been the United States and fears that basically the disproportionate top-heavy nature of spending in luxury that comes from the richest Americans. If they're seeing losses in the stock market or pressures in their 401ks, are they going to want to buy that next Louis Vuitton handbag? Those are the reasons why LVMH has been seeing the pressure today. So there might be another earnings cut from here, but you have to understand, the stock doesn't get too much cheaper than it does right here, right now. And the foundational multi-brand that is LVMH Group, there's nothing better like it in luxury outside of, say, Hermes.
So yes, and we talked about that Birkin bag as an investment that outperforms the S&P 500. So that's something for the ladies or the men. Okay, you mentioned valuation, and I want to underline that point because right now on my screen, I see it trading at forward 20 times earnings. Slightly lesser, cheaper than the S&P 500. But put that into context for us. Like, how often are you able to buy LVMH that cheap?
Almost never in the current modern paradigm. And to break down the earnings algorithm for LVMH, they also have paused on taking price in the last year as well. So the algorithm called the 10% plus earnings per share growth with the dividend at the 20 times, a lot of that can be driven by price as well. So luxury companies don't just benefit from unit volume. So it's not just about the number of handbags. The price per handbag tends to inflate over and above CPI as well. So there's very high operating leverage that comes with the LVMH group as they take pricing. And that's what I think is a lever that you have in your back pocket if volumes in the luxury recession does continue for a year or two longer.
So much of luxury stocks depend on what happened in China. Even though sales might take place in Europe and the US, it's still actually a China factor because they're leaving and they're traveling and they're going to those stores. And you just told me at the beginning of the show, you're not super thrilled with what's going on in China. So help me square your enthusiasm for your enthusiasm for LVMH and your like kind of concern on China.
So the Chinese economy is very heavy in what's known as fixed asset investment. So think ports, bridges, railroads, things like that. The consumer economy in China is relatively small, but still reasonably resilient. So the best alcohol producer in the entire world is a Chinese Baijiu company. We don't own it because we want to be careful about owning domestic Chinese equities where you need a special license to get in. So there's reasons for that. But the best growth opportunity at the best margins is in the Chinese consumer alcohol sector. The reason I say that is 1 in 3 of LVMH's sales and the rest of the luxury space, to your point, is the Chinese consumer, whether it's traveling abroad, what's known as travel retail, or buying more domestically, they tend to still produce and they tend to still buy in those times because the luxury is detached from broader GDP growth consistently because it's a very, very small group of people that buy a disproportionate number of the handbags.
We've got a question. You mentioned alcohol, and our next question is about Constellation Brands. Would you recommend buying the stock at these levels? Did Buffett buy it recently in the portfolio? Maybe
I can't recall off the top of my head.
One of his ads. But this one coming from Harrison on X. Do you like Constellation Brands? They own all kinds. They own like Kim Crawford wine. Of course, they own Corona.
The big win for Constellation was the Anheuser-Busch InBev transaction, where they bought Corona, and that was when Mexican imported beer really took off in the domestic market. So it really is a Corona conversation. The wineries, and the other parts, including their foray into cannabis, is a bit more of a sideshow. I'm generally cautious on this company because what I don't want with a consumer staples company, like Constellation, or specifically Constellation, is wildcatting capital allocation. So for that reason, I tend to be very cautious about that. But to answer our friend's question, there's other spirits companies and alcohol companies that you can own and participate on. So I'm not necessarily all that constructive on the alcohol space right now, but Diageo is where I would look as a multi-brand, multi-price ladder spirits company. So it takes a very long time to get Johnny Walker aged enough. So you tend to have the ability to take price more often than not. So if you want to own for premiumization and volume growth, Diageo is a great price at a bombed out valuation. And if you really want to stay in America, Anheuser-Busch InBev has likely the best diversified beer exposure as well, and now trading at a pretty attractive valuation. I'm not a buyer of that, but I just want to give better options than Constellation. Okay,
but Buffett did buy, and it looks like the stock had a great day in February because Buffett disclosed a stake. Though it's like one of the small stakes. It's not like Apple. It's for Buffett. But you mentioned Diageo. That stock, you said, is a bombed out valuation. It's trading at the lowest level since 2016. And I wonder, so tariffs are obviously an issue with a number of these stocks, but I also wonder if there is something structural going on with drinking and alcohol, whether it's the Ozempic effect, whether it's, the fact that millennials have children, they're making us very tired, and it's just not worth, a night of drinking. Like, I feel like drinking is on the decline, just like maybe smoking was, 20 years ago. Like, is that happening to these alcohol companies?
I think so. That's actually one of the reasons if we had to go to any spirits and beverage company, it would absolutely be Diageo. But we don't own it in the portfolio today for, frankly, all the reasons that you described. Is maybe the phone culture where, if you're at a university party, you probably don't want to be recorded by a million smartphones in high definition. Maybe there's reasons like that.
Doing a keg stand?
And doing a keg stand, things like that, right? So there might be something more cultural that is driving the spirits down. But right now, I'd say there is a cyclical downdraft too. So the cocktail culture that was in COVID, now that we've reopened and COVID's in the rearview mirror, it looks like that's really curtailed off at the same time as consumers are trading down. So we can worry about tariffs cyclically, and I do think that makes sense to do so. And we can worry about the structural growth algorithm for alcohol in nothing is private anywhere world anymore. Those are the longer term potential bear thesis. But right now, I think it's also a trade down along with some of the hangovers from COVID.
Our final question in the mailbag is from someone who took advantage of the dip to buy more Broadcom, which is a chip maker. I see you hold a fair bit, but lightened up at the end of last year. With current events in mind, are you building the position back up or selling off more? This one coming from Reddy Wilson on X.
So it's actually a little bit of a conversation we had about a year ago time. And what I'll tell you is, so the answer is we're selling more Broadcom, but we're also buying more Nvidia. And the reason for that is really twofold. Nvidia is the higher quality, more direct expression of the best parts of the semiconductor market, which is AI-related GPUs. AVGO is the next best option. So when number one
is Broadcom.
I apologize. Yeah, they've had a few name changes.
Yes.
So when number one is on sale, I always take the opportunity to take number two and roll more of it into number one. So that's one element of what's going on. The second part, and I talked about the potential for biblical levels of sanctions on the semiconductor companies as they export into China. AVGO is one of their fastest growing parts of the market. Let me define this a little bit. There's merchant GPUs, merchant silicon, which is Nvidia. And then there's custom ASICs, which is AVGO or Broadcom. Broadcom, one of their biggest potential customers is not just OpenAI, it's not just Google, it's also ByteDance.
Which owns TikTok.
So with everything going on with TikTok, with everything going on with the Chinese Chinese-U.S. tensions as it relates to semiconductors, they might lose a major customer or be prohibited from working as closely as they would want with one of their major customers. So I say all of those things to say AVGO Broadcom is one of the best managed companies in semiconductors, but it's priced cheaper and more expensive than Nvidia, when Nvidia is a far better expression of that growth. So expect more. We've already been selling down our AVGO and buying Nvidia, and I expect to continue to do so.
And both are down about 30% from their recent peak. So that's how he's rolling into from one non-Mag 7 into another Nvidia. Okay, now let's get into Dan's pro picks. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Dan, when I saw your top picks, I said, are you kidding me? Because I'll just say them right now. They're Mag 7. They're Microsoft, Amazon, Alphabet. And I thought, does it really take much to say, let's buy those three stocks? But to give you credit, it is coming at a time where the market has effectively thrown each of them out. So before we get into each, just high level, this is a bad year for tech. Mm-hmm. Why should investors scoop up these names?
So I had reservations about sending them too, because I thought, let me throw a little artisanal alpha your way, but we don't need to make this job harder than it needs to be. We don't win on artisanal alpha, we win on making money for clients. And I don't think there's a more obvious place to make money as we look ahead than some of the big tech stocks. So I think these companies are hiding in plain sight. So why is technology getting taken to the woodshed more recently? It's because expectations got really, really high for AI and AI derivative stocks, which is where the Mag 7 they're the most liquid ways to express that view in the market. They started getting too aggressive. And now there's cracks in that conversation. But that doesn't mean the fundamental position of any of these companies is truly vulnerable. And where it is, I think it's been more punitively express, and I think that sets up for an attractive payoff for clients.
Okay, and normally I roll my eyes because people are recommending it at all-time highs, which, that's fine because you can still make money. But you're recommending Microsoft, which is now trading at a more than 1 year low. It's been a while since I've been able to say that. The last time I obviously was 2022. So is that just a sell-off for no reason?
No, it's a sell-off for a reasonable reason. It's just you have to ask yourself, what is the second order effect of that? So investors said, Microsoft, we all know, and it's still, just because we all know, it doesn't mean it's not true. Microsoft is the most successful distributor of technology in history. So they have a relationship with the Fortune 5000, and that is an important anchoring. So whatever technology change and paradigm that comes, as long as Microsoft isn't 10 years late to it, they have a right to win. That's all true. So the AI conversation is why the stock went to north of 30 times earnings. And I think that's a reasonable barometer because it accounts for depreciation and the idiosyncratic cash flow effects that tech stocks can have sometimes. And now it's getting to 25 and lower. And that is, for Microsoft, I believe, a generational opportunity for it. Because let's talk about the AI thesis having cracks to it. That affects Nvidia more. That affects the power companies more. That affects a lot of other companies far more than Microsoft. But what makes Microsoft unique is they would love nothing more than to have OpenAI and every large language model commoditize, because as a distributor, you don't want proprietary technology sitting somewhere that you don't already own. So Microsoft is benefiting if there is a commoditization of LLMs. So
large language models. So it doesn't matter if OpenAI implodes. Not saying that is the case, but certainly it shouldn't be valued as much if you can do what they do at a fraction of the price.
Exactly.
Microsoft owns a stake. You think that's less relevant than the upside they'll get because all these large language models are now so much cheaper.
1,000%. They could write off the whole stake in OpenAI, and it would be a huge win for Microsoft. And here's a dynamic too with a company like this. All of the big tech companies, and including Microsoft, have spent so much money on data centers and so much money on compute that if they don't see a return on investment of that, and Microsoft is a very astute capital allocator. It's in the Satya Nadella days. If the AI revenue does not come to fruition, the CapEx is going to get massively cut at all these companies. And Microsoft is going to see a free cash flow wedge and an inflection, which means that suddenly we'll be talking about free cash flow conversion that's no longer in the 60s and back to about 100%. That's tremendous.
So I want to squeeze in Nvidia because it's not one of your top picks, but you did tell me you're buying the stock. All of this sounds terrible for Nvidia. Why do you still like Nvidia?
It's in the context of having technology companies. So it's all part of the balance, right? So we own a lot of garbage companies. We own utilities on one end of the barbell. And on the other end of the barbell, Nvidia is still one of the best, highest margin technology companies out there. And they're more likely to pinch out the Marvells, the Aristas of the world than actually lose share. So I do acknowledge that Nvidia's top line is potentially at risk as we look forward. But at the same time, even for Nvidia, it's trading at 18 times earnings now, but that's because the E is potentially at risk. So we size our Nvidia for our conviction. So we own disproportionately more Microsoft and some of the other companies we'll talk about than the potential company that's at risk.
And garbage stocks, you mean literal garbage?
Literal garbage company.
They're not garbage.
Yeah.
They are companies that move garbage. Okay, let's get to your second pick. This one is Amazon. And this one too, like you can buy at the lowest level in 6 months.
And one of the lowest valuations ever for Amazon. And the reason why it's important today is Amazon is not the aggressive spender that it used to be. So the big CapEx that they put forward in their logistics centers has changed now. So they're in the other side of the CapEx cycle on retail. Their incremental margins in the retail business, which is one half of the two parts that is Amazon, is now moving to a consistent and high profitability level.
I want to underline that because so much of Amazon's profit has not come from the retail. It has come from cloud computing. And everybody just is like, okay, fine, we'll take the retail.
Yeah.
But what we really want is cloud computing. And you're saying that retail is going to start actually mattering for profit.
Retail is one of the fastest growing parts of Amazon now because they've been so heavily investing and now they're seeing the other side of that. So retail margins are moving consistently higher and have so for several quarters. And I expect it to continue to. At some point, you just can't spend as much money as Amazon was spending in retail. The next piece is Amazon Web Services. Don't count that out either. They have the same type of quasi relationship with Anthropic that Microsoft has with OpenAI. And once again, just like with Microsoft, Amazon would love to have the large language model layer commoditized. And they will do everything they can to make sure that happens. So AWS is still a high grower. When we talk about software companies, Salesforce is growing 9-10%. Amazon Web Services is growing 19%. So high growth, high profitability, and peak CapEx at a generationally low valuation for Amazon is also, I think, a generational buying opportunity for the stock.
And this is just a little anecdote, but for the amount of time that Amazon has been competing with Walmart, this year is the first time analysts project Amazon will finally have more revenue
That's right.
than Walmart, which is like kind of insane.
Yeah, it takes a long time in retail. And I'll tell you one more thing about that. It's a good point you brought up with Walmart. Take the leaders in retail as we've pure played and we've known them, Costco and Walmart. They're trading at almost a 10-turn premium to Amazon. So that's a big premium for what are the number 2 and the number 3 operators in the e-commerce world, and the ability to bundle. Amazon can't be beat.
I just want to underline that Costco and Walmart trade more expensive than Amazon. And that's just because everyone's throwing out tech right now.
Exactly.
Okay, these aren't so boring after all. Your third one is Alphabet, and this is the parent company of Google. And I think with this one, you can say there is a bit of hair on this story, and investors are selling the stock kind of reflecting that. Are they going to be leaders in AI? What are the regulators going to do with them? Although maybe under Trump, it's sort of a different thing, and almost no credit to robotaxis. They're so ahead of Tesla.
Yeah, so this is the hairiest of the three, but it's also priced as such. We're talking about Google, which doesn't have net debt on its balance sheet at 15 times earnings. So you have a discount to the broader market for a clean balance sheet, and we shouldn't count that out either. But let's talk about the core reasons why the moat is being viewed as at risk. And I wouldn't say it's a slam dunk that they get this right. So large language models, they have Gemini, and they're competitive right there with Anthropic and OpenAI, and lead depending on who gets their update out faster. But let's talk about the distribution conversation we've had with enterprise as it relates to Amazon Web Services and Azure with Microsoft. Google has a massive distribution footprint through Maps, through their local search offerings as well. So don't count out search and their ability to get search queries through Gemini, and also improve core search in the way that they basically saved Reddit and made it into the meme stock that it is by trying to add more features to their search platform. So distribution matters, and this comes into the conversation around, they just got sued for effectively being a monopoly, and they lost the case because they are a monopoly. So the Department of Justice is throwing the book at them. And I do think that the outcome is going to be far more benign than what investors are hoping for as it relates to it because of the Trump administration. But at the end of the day, the risk is with Apple. If Apple walks away and Apple and Google basically have a bit of a breakup and split, that is the biggest risk for Google, not necessarily the DOJ.
And remind us of the relationship. Google pays Apple a lot of money to
$30 billion.
To be the browser.
Yes.
But a lot of people have made the point that we're all so ensconced in Google's life that we would just choose it for ourselves anyway. Because didn't they do that in Europe?
They did.
And what happened to Google's market share?
They have about 80% market share there too.
So there you go.
So there's a risk that you lose search market share, but that ignores the fact that the market might just keep growing in search as a whole, and it might be additive, the same way that cloud has been additive to on-prem compute for the most part. But more important than all this is, let's not count out the fact that Google is one of the most bloated companies in the entire world. So if search has been basically 100%, sorry, that's a bit of an exaggeration because they got to pay their tax to Apple, but it's effectively a 80% plus EBITDA margin business. So why are Google's margins in the 30s? It's because there's all these other pet projects that have permeated the organization for the better parts of 2 decades. They can get financial leverage they can drive operating leverage even if top line slows down with the cost cuts. And at 15 times, it's not a tech stock anymore. It's basically a value stock.
How much upside?
30-40%.
All right.
With the potential for more if they get the AI conversation right, where they dominate that in a way that they probably could with their distribution reach.
Dan, this has been an absolute pleasure. Thank you so much for joining me.
Thank you.
Thank you so much to Dan Rohinton of IA Global Asset Management for joining us. Make sure you tune in to our next episode. We've got Dan Dreyfus on the show. He is the portfolio manager at Bornite Asset Management. He's one of those U.S. investors who loves Canadian commodities, loves Canadian companies. He's going to tell us which ones he's buying right now. So get your questions in. You can email us at questions@inthemoneypod.com. You can find us anywhere on social media @InTheMoneyPod, and we'll catch you on the next episode.